Well, welcome back. Now we're going to talk about hedging. Hedging is the antacid for the risk averse. So most of us protect ourselves against risk in everyday life with life insurance. That's for loss of life and caring for your family financially. Also protective clothing against any injury, and you have medical cover to cover extensive medical bills. Short-term insurance against a loss of items or accidents that may occur. In the financial markets, the participants also require protection against substantial financial losses, and the players use derivatives like single stock futures, CFDs, and options, for which you also pay a premium and for which there is also no guarantee. So hedges seek to reduce risk by protecting an existing share portfolio against possible adverse price movements in the physical market. Hedges have a real interest in the underlying shares and use futures as a means of preserving their performance. So you don't necessarily want to sell your shares, then you will consider taking on a pure hedge. If we have buyers of physical shares, remember buyers of physical shares use single stocks and CFDs to protect against rising prices in the physical market. The long or purchasing hedge is where futures contracts are bought and later sold when shares are purchased on the physical market. So a rise or loss in the physical market price over the period of the hedge will be offset by a gain on the futures transaction. And conversely, a fall or gain in the physical market price over the period of the hedge will be offset by a loss on the futures transaction. So whatever the outcome, the buyer has obtained price security against rising price futures over the period of the hedge. So now also people who want to protect against risk or hedges use put options because they actually want to own the share at the end of the period. So they will obviously sell puts in the market if you look at the options market. Also, another advantage to the buyer of a futures contract is that it allows the buyer to benefit from a favorable market without having to lay out the full capital cost of buying the underlying asset. So you may not own the share, or you don't have to own the share to take on a hedge. So if you had to take a futures contract of a corporation, which would probably cost about, let's say for example, 4,500, and if you bought 100 shares, that would give you exposure of about 45,000. Could you take 4,500 multiplied by 100? That would be in the physical market. So any positive move in the share price during the term of the hedge will clearly have more effect on the futures position just by virtue of its gearing effect than on the physical position of shares. So with hedging, if you look at sellers of physical shares, if you have holders of physical shares, they also use futures to protect against falling prices in the market. Instead of selling the shares that they own and buying them back later once the market has fallen, a holder of such shares could instead sell the equivalent in futures contracts. The short or selling hedge is where a futures contract is sold by a seller and later bought back when the shares are sold in the physical market. A fall in the physical market price over the period of the hedge will be offset by a gain on the futures transaction. And if you have a rise in the physical market over the period of the hedge, this will be offset by a loss on the futures transaction. Whatever the outcome, again, the holder of the shares has obtained the price security against falling prices over the period of the hedge. The transaction costs are also greatly reduced using futures, and the brokerage incurred from selling the shares and then buying them again back later once the seller feels that the market has bottomed out would far exceed the costs relating to the futures transaction. So with hedges, you still own the shares, you neutralize any risk in whichever direction you're taking on the trade, you save on the costs, your tax is deferred because you're not selling the shares, so you don't have to pay income tax or capital gains tax to the receiver, and on the equity side you will continue to receive dividends.